In the ever-turbulent world of finance, Wall Street has always found a way to turn risk into profit, even when the risks are of its own making. Today, that old adage rings truer than ever. Beneath the surface of economic uncertainty, soaring inflation, and shifting global markets, a new kind of trading frenzy is sweeping through America's financial heart, one that increasingly resembles a casino floor more than a temple of capitalism. With algorithms as the dealers and hedge funds as high-rolling gamblers, the stakes have never been higher, and the public, as always, remains both spectator and collateral. The modern market is no longer driven purely by fundamentals like company earnings, innovation, or long-term value. Instead, it is animated by speed, milliseconds that determine millions. High-frequency trading firms, armed with artificial intelligence and supercomputers, execute thousands of trades per second, skimming profits from the micro-fluctuations of price. Hedge funds chase volatility, betting on chaos instead of stability. Meanwhile, investment banks and institutional traders, once seen as steady hands guiding capital to productive use, are now actively speculating on short-term moves, derivatives, and complex instruments that few outside the industry can even explain. This is not new, but the scale is unprecedented. The U.S. Federal Reserve's years of easy money and quantitative easing flooded the system with liquidity, encouraging speculation over production. As interest rates climbed in recent years, traders simply found new games to play, from options gambling to crypto surges and AI-linked stock manias. Every corner of the financial system seems to have turned into a bet. The result: Wall Street has effectively built a casino atop the economy, where everyone from pension funds to retail investors is forced to play along or risk being left behind. At the center of this trading shuffle are the market makers, massive firms like Citadel Securities, Virtu Financial, and Jane Street. These players act as intermediaries for nearly every trade on the U.S. exchanges, providing liquidity while taking tiny profits on each transaction. Yet those tiny profits, multiplied across trillions of trades, create an empire. They dominate not through market insight, but through technological dominance. The faster their algorithms, the more they win. The slower players, including traditional investors and ordinary individuals, lose by default. Wall Street defends this system as efficient. The constant trading, they argue, ensures smooth markets and accurate pricing. But critics see a different reality: a feedback loop that rewards speculation, amplifies volatility, and divorces finance from the real economy. When traders are rewarded for betting on short-term swings rather than investing in companies that create jobs or innovation, the market's moral compass drifts. This moral drift is most evident in the explosion of derivative trading, instruments originally designed to hedge risk but now used to magnify it. The daily volume of options trading in the U.S. has surpassed that of the underlying stocks themselves, turning the market into a leveraged guessing game. The consequences are far-reaching. Sharp, unpredictable movements in stock prices can wipe out the savings of retail investors. Hedge funds that control vast pools of capital can trigger mini-crises through algorithmic errors or sudden portfolio rebalancing. Meanwhile, the real economy, small businesses, workers, and consumers, finds itself increasingly disconnected from Wall Street's winnings. The wealth generated by these trading shuffles often remains confined to a narrow elite, fueling inequality and resentment. Even regulators struggle to keep pace. The Securities and Exchange Commission (SEC) has proposed new rules to increase transparency and curb market manipulation, but its tools are outdated in an era where trades happen faster than human reaction times. Moreover, many of the biggest players in this financial casino wield immense political influence, ensuring that reform remains slow and watered down. Still, some analysts argue that this is simply the natural evolution of capitalism. Markets, they say, have always adapted to technology and innovation. But critics warn that when the system becomes so detached from tangible value, it starts eating itself. History offers grim reminders, from the dot-com bubble to the 2008 financial crisis, of what happens when speculation outweighs substance. The real question, then, is not whether Wall Street can sustain this casino economy, but for how long. As automation, artificial intelligence, and global instability reshape the landscape, even the masters of the game may find themselves trapped by the volatility they once profited from. For now, the roulette wheel spins on, the algorithms hum, and fortunes are made and lost in the blink of an eye. In this modern financial circus, Wall Street isn't just playing the game, it's the house. And as history has always shown, the house rarely loses.